Today we're diving into two heavyweights in the ETF world that will transform your investment strategy, QQQ and JEPQ. One of these ETFs is offering a jaw-dropping yield of over 12%, while the other has consistently outpaced the S&P 500 for the past decade. But which one is the ultimate game changer for your portfolio? Stick around because in the next few minutes, we're going to break down their yields, payout ratios, and everything you need to make an informed investment decision. Imagine this. $100,000 investment today, one of these ETFs could potentially grow that investment to an astounding $1,745,940 over the next 30 years. On the flip side, the other ETF could generate substantial dividend income, ensuring a steady cash flow that might just make retirement a lot more comfortable. Can you guess which ETF does that? We're diving into the latest data from July 2024 to uncover these secrets. But that's not all. We'll also dissect the yields and payout ratios of these two ETFs, compare their performance, and explore which one aligns best with your investment goals. Whether you're chasing explosive growth or seeking reliable income, we've got real numbers and solid analysis to help you decide. Holding the investment for 30 years, Harry would accumulate around $375,000 in total dividends. Here's the plan for today. First, we'll break down the current yield and payout ratio of each ETF. Next, we'll analyze the growth potential and historical performance. Finally, we'll reveal which ETF might be the perfect fit for your portfolio. Stay tuned because by the end of the video, you'll know exactly which ETF could be more of a game changer and what your portfolio is needing. Ready to unlock the secrets of QQQ and JEPQ? Let's dive in. Invesco QQQ Trust. The Invesco QQQ Trust, commonly referred to as the QQQ, is one of the most popular exchange-traded funds ETFs in the market, tracking the Nasdaq 100 index. This index is comprised of 100 of the largest non-financial companies listed on the Nasdaq stock exchange, making QQQ a favorite among growth-oriented investors. Managed by Invesco, the QQQ ETF has consistently attracted significant investor interest due to its focus on technology and innovative companies. As of July 2024, QQQ boasts a compound annual growth rate of 18.2% over the past decade. This impressive growth rate is driven by its heavy weighting in, tech giants such as Apple, Microsoft, Amazon, and Alphabet, which, of course, together make up nearly 40% of the fund's total assets. These companies have shown remarkable growth, with Apple achieving a 5-year CAGR of 20.1%, Microsoft 18.6%, Amazon 19.4%, and Alphabet 17.8%. The overall growth of QQQ is closely tied to the performance of these leading tech stocks, which have consistently outperformed the broader market. The expense ratio of QQQ is 0.20%, which is relatively low, especially considering the high growth potential it offers. This low expense ratio is one of the reasons why QQQ is attractive to investors who seek exposure to high growth tech stocks without incurring substantial costs. For a $10,000 investment, the annual fee would be around $20, which is quite competitive compared to the other ETFs with similar growth profiles. QQQ's payout ratio stands at 28%, reflecting its strategy of reinvesting a significant portion of earnings back into the company within the fund. The reinvestment supports continued innovation and growth, aligning with the ETF's focus on high growth potential. The dividend yield of QQQ as of July 2024 is 0.55%. While the yield is relatively low, it is important to note that QQQ is primarily geared towards capital appreciation rather than income generation. The top holdings of QQQ include Apple Inc., Microsoft Corp., Amazon.com Inc., Alphabet Inc., Class A, and NVIDIA Corporation. These companies are the forefront of the technology and innovation, driving significant advancements in their respective fields. For instance, NVIDIA has reported a 5-year CAGR of 25.3%, reflecting its dominance in the graphics processing unit market and its expansion into artificial intelligence and data center solutions. In terms of performance, QQQ has delivered an average annual return of 21.4% over the past 5 years. The strong performance is a testament to the robust earnings growth and market leadership of its constituent companies. For example, Apple's revenue grew from $260 billion in 2019 to $394 billion in 2023, showcasing its ability to generate substantial returns for investors. Investing $100,000 in QQQ today could potentially grow to over $1.2 million in 30 years, assuming it continues to deliver an annualized return of around 10%, which is a conservative estimate based on historical performance. This potential growth underscores the power of compounding and the benefit of investing in high-growth sectors. In summary, the Invesco QQQ Trust offers investors a unique opportunity to gain exposure to some of the most innovative and high-growth companies in the market. With a low expense ratio of 0.20%, a payout ratio of 28%, and a focus on technology leaders, QQQ stands out as a compelling investment for those looking to capitalize on the growth of the tech sector. Despite its relatively low dividend yield of 0.55% and the potential for significant capital appreciation, makes QQQ an attractive option for the long-term investors. JPMorgan Equity Premium Income ETF. JEPQ. The JPMorgan Equity Premium Income ETF is an income-focused exchange-traded fund designed to provide investors with attractive yield and capital appreciation. Managed by JPMorgan Asset Management, JEPQ aims to generate income by investing in high-quality, large-cap stocks while utilizing a covered call strategy to enhance its yield. This approach makes JEPQ a popular choice among income-seeking investors who also desire some growth potential. As of July 2024, JEPQ has a compound annual growth rate of 7.8% over the past 5 years. The fund's strategy of combining high dividend stocks with covered all call options has enabled it to achieve a balance between income and growth. JEPQ's portfolio includes leading to companies such as Johnson & Johnson with a 5-year CAGR of 6.2%, Procter & Gamble at 7.1%, and Pfizer at 5.4%. These companies are known for their stable earnings and consistent dividend payments and contributing to the fund's overall performance. The expense ratio of JEPQ is 0.35%, which is reasonably given the active management and covered call strategy employed by the fund. For a $10,000 investment, the annual fee amounts to $35. This cost is justified by the potential for higher income generation through the fund's investment and option strategy. JEPQ's payout ratio stands at an impressive 85%, reflecting its commitment to returning a substantial portion of earnings to shareholders in the form of dividends. As of July 2024, the dividend yield of JEPQ is 12.5%, making it one of the highest yielding ETFs in the market. This high yield is achieved through a combination of dividend income from the underlying stocks and premiums earned from selling all call options. The top holdings of JEPQ: Johnson & Johnson, 5.3% of assets, Procter & Gamble, 4.7%, Pfizer, 4.2%, Verizon Communications at 4.1%, and Coca-Cola at 3.9%. These companies are leaders in their respective industries and have a history of paying reliable dividends. For instance, Verizon has a 5-year CAGR of 4.8%, driven by its strong market position in the telecommunications and consistent cash flow generation. In terms of performance, JEPQ has delivered an average annual return of 9.5% over the past 3 years. This performance is bolstered by the fund's ability to capture income through dividends and option premiums, while also benefiting from the price appreciation of its underlying holdings. For example, Procter & Gamble's stock price has risen from $125 in 2019 to $155 in 2023, reflecting its steady growth and resilience in the consumer goods sector. In summary, the JPMorgan Equity Premium Income ETF offers a compelling option for income-focused investors with an expense ratio of 0.35%, a high payout ratio of 85%, and a robust dividend yield of 12.5%. JEPQ stands out as a top choice for those seeking to maximize income while still enjoying some capital appreciation. The fund's strategy of combining high dividend stocks with covered call options has proven effective in delivering attractive returns, making JEPQ a valuable addition to any income-focused investment portfolio. Long-term growth projections. Growth projections of QQQ. Let's consider Harry, who invests $100,000 in the Invesco QQQ Trust and holds it for different time periods. QQQ, known for its focus on technology and innovation and the innovative companies, has demonstrated strong growth potential for over the years. 1-year projection. After 1 year, assuming QQQ continues to grow at a historical average annual return of approximately 10%, Harry's investment would grow to $110,000 with QQQ's relatively low dividend yield of 0.55%. Harry could expect to receive around $550 in dividends over the year. 5-year projection. Over 5 years, the power of compounding significantly impacts Harry's investment. With an average annual return of 10%, his $100,000 could grow to approximately $161,051. In terms of dividends, Harry would receive about $3,025 cumulatively over these 5 years, assuming the yield and payout ratio remain constant. 10-year projection. Looking further ahead, after 10 years, Harry's investment could potentially grow to $259,374, given the same annual growth rate of 10%. Over this period, he would earn about $7,650 in total dividends, assuming the yield stays constant. While the dividend income is modest compared to the growth in principal, it contributes to the overall return. 20-year projection. After 20 years, the compounding effect becomes even more compound and pronounced. Harry's $100,000 could grow to a substantial $672,750 at a 10% annual growth rate. Over these 2 decades, Harry would collect around $22,050 in dividends, significantly enhancing this total return. 30-year projection. If Harry holds his investment for 30 years, the initial $100,000 could potentially grow to a remarkable $1,745,940, assuming a consistent 10% annual return. Over these 30 years, he would approximately earn about $49,350 in total dividends. While the dividend yield is not the main attraction of QQQ, the substantial growth in the principal makes it a powerful investment for long-term wealth accumulation. Growth projections of JEPQ. Now let's consider Harry's $100,000 investment in the JPMorgan Equity Premium Income ETF, which focuses on generating income through high-yield dividends and a covered call strategy. 1-year projection. After 1 year, with JEPQ's impressive yield of 12.5%, Harry's investment would provide approximately $12,500 in dividend income. Assuming the fund's net asset value remains stable, Harry's total investment value would be $112,500 after 1 year. 5-year projection. After 5 years, a consistent high yield would significantly enhance Harry's income. With an annual dividend income of $12,500, Harry would receive a total of $62,500 in dividends over 5 years. Assuming the NAV remains relatively stable, his total investment value would be around $162,500. 10-year projection. In 10 years, a cumulative effect on the high yield becomes even more evident. Harry would earn about $125,000 in total dividends over the period. If the NAV of JEPQ stays stable, his total investment value would reach approximately $225,000, with half of it coming from dividend income. 20-year projection. After 20 years, Harry's total dividend income would amount to approximately $250,000, assuming the annual yield remains at 12.5%. If the NAV does not fluctuate significantly, his investment value would be around $350,000. This consistent income stream is ideal for those relying on investment income. 30-year projection. Holding the investment for 30 years, Harry would accumulate around $375,000 in total dividends. Assuming the NAV remains stable, his investment value would be approximately $475,000. This scenario highlights JEPQ's strength in providing substantial income, making it a solid choice for income-focused investors. Navigating the ups and downs of QQQ. The Invesco QQQ Trust is known for its significant exposure to technology and innovative companies, which inherently makes it more volatile compared to broader market indices. The high concentration in tech giants such as Apple, Microsoft, Amazon, and Alphabet means that QQQ's performance is closely tied to the technology of sector's health. One of the key risks associated with QQQ is its susceptibility to market corrections. For example, during the COVID-19 market crash in March of 2020, QQQ lost about 20% of its value within a few weeks. However, due to resilience and rapid recovery of tech stocks, QQQ bounced back quickly and ended 2020 with a remarkable annual return of over 48%. QQQ also exhibits its higher volatility compared to traditional broad market ETFs. Its beta, a measure of volatility relative to the market, stands at approximately 1.3%. This indicates that QQQ is 30% more volatile than the broader market. A higher beta can lead to significant price swings during the market turbulence. For instance, during the tech bubble burst in 2000, QQQ plummeted by nearly 80% from its peak, highlighting its vulnerability to sector-specific downturns. Market conditions such as interest rate hikes can also impact QQQ. Higher interest rates typically result in the lower valuations for growth stocks, which form the bulk of QQQ's holdings. For example, in 2022, the Federal Reserve's aggressive rate hikes lead to a noticeable decline in tech stock valuations, causing QQQ to drop by around 25% that year. Despite these risks, QQQ's long-term growth potential remains strong due to its focus on leading technology companies that drive innovation and economic growth. Investors should be prepared for the short-term volatility and market corrections that can benefit from substantial long-term returns if they stay the course. Balancing income and stability with JPEQ. The JPMorgan Equity Premium Income ETF is designed to provide high income through dividends and a covered call strategy which inherently carries a different risk profile compared to growth-oriented ETFs like QQQ. JEPQ invests in high-quality, large-cap stocks and uses covered calls to generate additional income, which can help cushion against market volatility. One significant risk of JEPQ is its resilience on the covered call strategy, which can limit upside potential. In bullish markets, when stock prices surge, JEPQ might underperform compared to the other equity ETFs because the covered call options cap the gains. For instance, during the strong market rally in 2021, JEPQ's returns lagged behind broader market indices with an annual return of around 12% compared to the S&P 500's 26%. JEPQ's beta is lower than that of the QQQ, standing at approximately 0.8%, indicating that it is less volatile than the broader market. The lower beta is a result of the income-focused investment approach and stabilizing effect of the covered call strategy. However, JEPQ is not immune to market downturns. During the COVID-19 market crash, JEPQ saw a decline of about 15%, which was less severe compared to QQQ, but still significant. Market conditions such as prolonged low interest rates can impact JEPQ differently. In low interest rate environments, high dividend stocks and income-focused strategies like JEPQ tend to attract more investors seeking, yield, which can support the ETF's price. However, if the interest rates rise, income-focused ETFs may face pressure as investors shift towards bonds and other fixed income securities offering higher yields. A notable past incident impacting JEPQ was a 2018 market correction where it experienced a decline of around 10%. This period highlighted how JEPQ's income strategy provided some downside protection, but still left it exposed to market risks. Overall, while JEPQ offers a more stable income stream with lower volatility, investors should be aware of the trade-offs, including capped upside potential and sensitivity to changing market conditions. So which ETF aligns with your financial goals? Are you drawn to the explosive growth of QQQ or the steady income stream of JEPQ? The choice is yours, but at the same time, it is the time to act now. Markets wait for no one. Dive into the data, analyze your needs, and make your move. Don't let this opportunity pass you by. Hit that like button, subscribe, and share your thoughts in the comments below. Ready to transform your portfolio? Let's make it happen together. See you in the next video.